Options are the most complex financial instruments for many investors. Here I would like to summarize most of these concepts at very high level. On the left side, you can see option measures. On the right side, you can see option strategies. These are the most popular option strategies that traders use. There are many strategies available that limit risk and maximize your return. What's important is you should know how they work and how you can take the advantage of power and flexibility that options offer. So when it comes to measures, you should know about Greeks, delta, gamma, theta, vega, open interested, how many people are interested in, and volume, implied volatility, that is like how much it can move up or down with the volatility, like option price plus that volatility percentage multiplied by the option price, that can tell you like how much what's the range is. So usually sigma like 68.7% probability as per the stats. Well, when it comes to delta, $1 change in stock price, how much option price is expected to move. That means that 40 delta means 40 cents it can move for the $1 change in the underlying asset price. And 40 delta also, that means that 40 cent, 0.4 delta also means that 40% chances of being this option in the money at the expiration. So usually for calls 0 to 1 and puts is 0 to minus. So it can be negative for puts. And gamma is the rate of change in the delta over time. And also the first derivative of delta and second derivative of option price, and measures the stability of the delta. Since delta talks about the probability, also gamma measures the stability of the probability. Theta is the time decaying as the option moves to the expiration. It nears to zero. Vega is nothing but the forward volatility, implied volatility change, the risk, that measures the risk of change in that. And high volatility means options are risky, right? So long options have positive vega, so vega falls as the option is getting closer to the expiration. So these Greeks tells us how sensitive specific trade is to price fluctuation, volatility fluctuations, and then passage of time. This combination of Greeks and risk graphs and option statistics like IV percentile and P by C ratio, put by call ratio, and give you the powerful insights, all this together, and take your option trading to the another level. So now let's look into your what's your expectations and what kind of action you can take based on your expectation. So long option, short option. So what does it mean, right? So long is you're buying an option to open the position. So you pay for premium, right? When you're longing, you pay for premium. Short is you're selling or writing an option to open the position. And you can close that position by buying them back. So I only talk about longing here to avoid any confusions, but to simplify, shorting is exactly the reverse of the longing, the option strategies. So if your expectation is the underlying asset is to go high in the near future, then either you buy a long call or you choose long vertical call spread. If your expectation is the underlying asset is go down in the near future, you will choose either long put or you choose the long vertical put spread. So the interesting point here is with the vertical long call and with the vertical long put spread, you're longing a call or put, and shorting or selling some of the portion of its value. So you're buying a call and you're selling some of it to reduce it, to reduce the cost, net premium will be lower than buying a one call. And also, of course, it eventually limits your profit, but you're trading off that. So doing that, you're reducing your costs and you're limiting your profits because you sold out the other option of the other portion of the option. Ultimately, the structure is for call spread, you're longing a call and shorting a call, plus combining, right? So long call strike price is closer to the current stock price, and then short call strike price is far away from the current stock price relatively. So if your expectation that stock goes up or down, but you're not sure about the direction, then you probably can choose either straddle or strangle. They both have the same strategies by longing a call and longing a short, but they differ with the strike price. Straddle choose the same strike price, but strangle choose the out of money for its call and put. So when your strategy is to profit from neutral price action, you can choose a long butterfly or iron condors. So what do you need to know about option? Strike price, stock price, and expiration. If the stock is trading at $55 for a call option, if you're choosing the strike price within that $55, then it's in the money. Here in the example, we chose $50 call. That means that you're choosing within that $55, that will be in the money. If you're choosing above the 55, then it will be out of the money. And if you're choosing the strike price, same exactly the stock price, then it's at the money. That's what all you need to know about it. And then let's look into the long call scenario. It's buying the 60 call, stock is trading at 55, and strike price is 60. Why? Because you bought the 60 call. There's some expiration, and expiration you're saying that it's well beyond the strike price you bought. That means that your stock is trading at 55 and then it moved to 70, right? Well, it when moved to 60, you don't make any money, right? But you bought this, right? Strike price. So when it moves to 61, well, you make $1. 62, $2. 63, you will make $3. But remember, you paid $3 premium, so when it comes to 63, you will be that's the break-even point because you got back your $3 premium. So beyond that point, it's all your profit. Well, the profit is unlimited if the stock can go at any point. But at the expiration, you have to see where it's trading at. That's going to be the difference of the strike price at that point to your strike price minus this premium is your max profit. And same thing with the put. It's a downside direction. You're taking the advantage when the stock goes down. So you're going to make a profit when it goes down. The max the stock can go down is $0. So ultimately your maximum profit will be your strike price. Let's say here you bought the $50 put. That means that your $50 can be your maximum profit, but since you already paid $3 premium, so your maximum profit can only be the 47. So how much maximum you can lose when you're longing a call or put? Whatever the premium you paid, that's your maximum loss, right? So now let's look into the vertical call spreads. So what you're doing is you same like call, you sold out some portion on it. So this is how it was, and it sold out. Because of selling out, it moved from -3 to 3. Before our premium is $3. Now we collected, because now it's -2. Why? It's $2 premium. Why? Because you short this and you got $1 from it. So overall your cost is reduced $1, but you're limiting your profit. If the stock goes beyond this point, you don't get any profit because you sold it out, right? That's how you can remember that part. So you can see the long call here, and you sold out this portion, so you got $1 back. So now your net cost is $2, and your maximum profit limits here because you sold out this portion. So you can see the scenario and apply your own and think about it, and you can digest the concepts. And then long put is the same thing, and you use the long put, and you sold this piece that becomes the put spread, and you're like limiting your profits and reducing the cost. And also you're getting to the profits early, because since your cost is reduced, so we'll be into the break even early and you will be into the profits early. The strangle is and straddle mostly do the earnings, and because you don't know the direction, sometimes it can go up or down based on the expectations and Wall Street expectations. So there's more volatility. People take advantage of buying the straddles, long the straddles of strangle. Only the difference is the strangle will have the out of the money strike price, and whereas the strangle is the same strike price for both call and put. But now these are the plain call and put. Think about like making this a spread and making this as a spread as well, and shorting them will turn them to the iron butterfly for the straddle, and for strangle it will be iron condor. So don't go crazy, these are just names. What's important is think about the right one to hedge or make profits. So productive food, as you see the description, so you'll have a put along with the stock, you buy it, and the covered call, you'll sell the call, and caller is like both selling the call and put and wanting the stock. And cash covered put is like you have the cash, and you sold out the put.